Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open. The market flirts with record highs, but volume has evaporated, creating a dangerous divergence. Watch for the GDP print to either ignite a Santa Claus rally or trigger a vicious reversal at the bell. Second, Hollywood bloodbath. A $40 billion power play rocks the battle for Warner Brothers Discovery, but a hidden truth triggers a national security crisis. Larry Ellison's jaw-dropping guarantee was meant to seal the deal, but a link to foreign funds put CNN's fate in jeopardy. Will WBD stock surge at the open, or will this high-stakes gamble implode? Finally, gold skyrockets past a historic $4,400, but silver's 138% explosion reveals the real story. This isn't just a safety play. Central bank de-dollarization and a hidden industrial boom are fueling the fire. With retail frenzy at a peak, is this a massive bull trap waiting to spring? Warning, the S&P 500 is flirting with record highs, hovering just below the psychological 6,900 level, but don't let the green screens fool you. Beneath this festive rally lies a dangerous divergence between price and participation that demands immediate attention. While the S&P 500 advanced 12 basis points to close at 6,886, trading volume has evaporated ahead of the holiday. The Nasdaq composite is masking severe internal weakness, while the Dow Jones Industrial Average is quietly outperforming, signaling a rotation into value that many growth investors are missing. Why is this specific moment so critical? Because the market has sprinted nearly 10% in just 3 trading sessions on the back of thin liquidity, and we are staring down the barrel of the delayed third quarter GDP release. The consensus sits at 3.2%, yet the Atlanta Fed's real-time model is flashing a hotter 3.5%. This gap is massive. From a policy perspective, a hotter GDP print would confirm the economy is running well above the Fed's long-term growth estimates. This complicates the picture for rate cuts in 2026. CME futures already show an 80% probability that the Federal Reserve will pause in January. The capital reaction is visible in the rotation to financials. Investors are realizing that if rates stay higher for longer, net interest margins for big banks expand, while the present value of future cash flows for unprofitable tech stocks compresses. Analysts warn that if the GDP data misses below 3%, it could shatter this fragile confidence and reignite recession fears overnight. Conversely, a beat would fuel the Goldilocks narrative, but it would also likely lock in higher yields, putting pressure on long-duration assets. In the technology space, the concentration risk has reached historic extremes. The Magnificent Seven now dictate the direction of the entire index. Nvidia climbed 1.3% and Micron surged 2% on strong AI infrastructure demand, validating the hardware trade. However, market breadth tells a darker story. Data shows that only 630 stocks in the Nasdaq are outperforming the best mega-cap names. This mathematical vulnerability means that a modest correction in just 7 names could drag the entire index down, regardless of how the other 493 companies perform. Meanwhile, geopolitical tensions have jolted the energy sector. With the US naval blockade of Venezuelan oil, crude prices spiked near $58 a barrel. But watch closely, energy stocks are lagging the commodity price, suggesting investors remain skeptical about the longevity of this supply shock. Given the broader concerns about global demand weakness, we are also seeing a fascinating risk-laden dynamic in the utilities sector. Traditionally a defensive safe haven, utilities have transformed into an aggressive AI play based on data center power demand. The sector is now trading at 18.5 times forward earnings, a significant premium to its historical average of 15. Analysts point out that this valuation stretch leaves the sector vulnerable. If the risk-on sentiment accelerates, capital may rotate out of these expensive bond proxies and into cyclical industrials. The market rhythm has shifted from a broad advance to a selective high-stakes game of musical chairs. The next 48 hours will determine if this is a sustainable Santa Claus rally or a liquidity trap. The 6,950 level on the S&P is the line in the sand. If the index fails to break through decisively on the back of the GDP print, experts warn that the window for profit-taking may close rapidly as institutional selling pressure returns post-holiday. Keep a close watch on the 10-year Treasury yield and the breadth of the advance. These are the true indicators of the market's health heading into the new year. The story begins with a decision that caught everyone by surprise. A blockbuster battle for a media empire is reaching a fever pitch. shareholders of Warner Brothers Discovery, ticker WBD, are caught in a massive tug of war between two giants, Paramount and Netflix. So the thing is, you have to watch something called the merger arbitrage spread. It's the gap between WBD's current stock price and the offer prices from Paramount and Netflix. Heading into the open, a narrowing gap toward Paramount's $30 offer would signal rising investor confidence in that deal, while a price hovering closer to Netflix's $27.75 offer suggests the market sees that as the more likely outcome. It's essentially a real-time poll on which side is winning. The situation presents a fascinating duality for shareholders. On one side, Paramount is making a hostile all-cash offer of $30 per share to buy the entire company. At the same time, the WBD board has already agreed to a deal with Netflix, ticker NFLX, to sell its studio and streaming assets for a lower price of $27.75 per share, a deal that also includes stock and a spin-off of its cable networks. The board's preference for a lower price seems counterintuitive, but actually, this isn't just about the headline number. The Netflix deal leaves shareholders with a piece of the original company, a stub of the remaining cable networks like Discovery and CNN. A huge fight is brewing over the value of this cable stub. Paramount's offer implies these networks are worth almost nothing, while other bids have valued them in the tens of billions. You know, this is a crucial market test for the future of traditional TV in a streaming world. Lurking in the background is the fact that either deal is set to become a major antitrust test case. The Department of Justice will have to decide how it defines the media market in the streaming era. This outcome will establish a new precedent, potentially blocking future media consolidation or greenlighting the creation of a few dominant super streamers. This regulatory uncertainty is a major reason the WBD board might favour the Netflix deal, which they see as having a clearer path to approval. But what really brought this to a head was the next development. After the WBD board raised concerns about Paramount's financing, one of the world's richest men just entered the fight. Oracle founder Larry Ellison, whose son runs Paramount, stepped in with a jaw-dropping, irrevocable personal guarantee of over $40 billion to back the deal. A personal guarantee of this size is both a sign of immense conviction and, believe it or not, a potential red flag. Now get this. In today's environment of higher interest rates, large leverage buyouts or LBOs are much riskier and more expensive to finance. Ellison's guarantee is meant to calm those fears. However, if you zoom out, you'll see another layer of strategy at play. A significant portion of Paramount's financing is reportedly coming from Middle Eastern sovereign wealth funds. This puts the deal squarely under a geopolitical microscope. This is a massive power play designed to eliminate any doubt about the money. Yet, some WBD insiders are reportedly unimpressed, privately joking with the movie title, "Where's Popper?" and pushing for the Ellisons to commit more of their own personal cash, not just a guarantee. Here's where it gets interesting. The involvement of foreign state-linked money in the ownership of a critical US news asset like CNN will almost certainly trigger a national security review by the Committee on Foreign Investment in the United States, or CFIUS. A CFIUS block would kill the deal instantly and could chill foreign investment in other sensitive US sectors. This is a massive, unpredictable risk that the Netflix deal simply doesn't have. For the WBD board, the certainty of the Netflix deal, backed by its investment-grade balance sheet, can easily outweigh Paramount's higher but far riskier offer. This all sets up a high-stakes game of chicken ahead of the bell. Do shareholders take Paramount's guaranteed cash despite the huge regulatory and financing hurdles? Or do they side with the board and bet on the safer, albeit lower-priced Netflix deal? The decision could ignite an all-out bidding war. All eyes will be on Warner Brothers Discovery at the opening bell to see which side investors are betting on in this Hollywood showdown. At the open, look for WBD's stock price. If it surges past the Netflix offer of $27.75 and pushes toward $30, it means the market believes Larry Ellison's power play is working. But if the stock struggles to break above that $27.75 level, it's a clear sign that investors fear the deal's complexity and the massive regulatory hurdles ahead. Speaking of high-stakes risk, our next story shifts from corporate drama to global economics, where a massive flight to safety is underway. Gold has just smashed through another record, trading above $4,400 an ounce for the very first time. The precious metal has now rocketed more than 68% this year, its biggest surge since 1979. One analyst from the gold marketplace, Bullion Vault, is pointing the finger directly at Washington, saying, quote, "The precious metals market says that President Trump has really triggered something and gold has gone crazy this year." He adds that the trade war, attacks on the US Federal Reserve, and geopolitical tensions are all seen as provocations driving investors to hunt for safety. Gold's price may be embedding an unusually high geopolitical risk premium that isn't showing up in other assets like stocks. It suggests that gold investors are hedging against a low probability but high impact tail risk event. So, watch for any headlines suggesting a de-escalation in trade or military tensions, as that could suddenly remove a major pillar of support for gold's price at the open. But that's not the whole picture. Silver is actually putting gold's rally to shame. The price of silver has exploded 138% so far this year, also hitting a new record high. Platinum is trading at a 17-year high. This is a massive, coordinated rush into hard assets. Interestingly enough, silver's incredible outperformance reveals a more complex story. After all, this isn't just a safe haven play. Silver is also a critical industrial metal used in solar panels and electric vehicles. The historic gold to silver ratio, which tells you how many ounces of silver it takes to buy 1 ounce of gold, has been shrinking. This suggests a strong global manufacturing recovery and a boom in the green energy transition are also fueling this fire. This complicates the inflation outlook because strong industrial demand could prevent the US Federal Reserve from cutting rates as aggressively as the market expects. Beneath the surface, there's another powerful force at play. According to analysis from Goldman Sachs, central banks around the world are aggressively expanding their own physical gold holdings. They're doing it to counter economic turbulence and critically to reduce their reliance on the US dollar. This is a trend known as de-dollarization, and it's accelerating. The World Gold Council reports that central banks have bought over 1,000 tons of gold for the third year in a row, with the People's Bank of China being a major buyer. When we place the US dollar's falling share of global reserves alongside China's strategic buying, the contradiction with US policy goals becomes clear. For Chinese investors, this is a clear signal of a long-term strategic shift to diversify national wealth away from the dollar, which could help insulate the yuan and the domestic economy from future US policy shifts. This all sets up a critical question for the opening bell. With investors fleeing to the perceived safety of metals and the consensus building for 2 more US interest rate cuts in 2026, this massive rush signals deep-seated anxiety about economic turmoil and a weakening dollar, posing a major test for investor confidence in the stock market right at the open. But there's a catch to all this excitement. This rally is attracting a massive surge in speculative retail buying. We're seeing record inflows into popular funds like the SPDR Gold Shares ETF, ticker GLD, which allows people to easily invest in gold. This kind of retail-driven frenzy makes the market vulnerable to sharp reversals if sentiment shifts, posing a risk to investors who are just now jumping in. At the open, look for extreme volatility in both gold and silver miners.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.